Okay, let's unpack this. We're doing a deep dive today into the One Big Beautiful Bill Act of 2025, signed on July 4th.
Yeah.
This thing is really the most transformative tax reform we've seen since, 2017? It touches pretty much everyone.
It really does. And it's kind of got this dual nature.
Okay.
On one hand, it makes a lot of the 2017 tax cuts permanent. So that brings some certainty.
Okay, some stability there.
Right. But then it adds this whole layer of new, very targeted tax breaks.
Mm-hmm.
And what's really crucial to grasp is how these cuts are paid for.
How are they paid for?
Well, through pretty significant spending reductions. We're talking about social safety net programs, Medicaid, SNAP included. And the distributional effects, based on the sources we've reviewed, seem pretty clear. Generally, middle and upper income households gain resources, but lower income households might actually see a net decrease because of those benefit cuts. And just to be clear, we're just relaying what the sources say here, not taking a side.
Got it. So for you listening, what does this mean practically? Sounds like opportunities for savings, yes, but also more headaches.
Exactly. More complexity, new compliance stuff to worry about, and definitely a heightened IRS audit risk in certain areas.
Okay, let's jump into some specifics. What about this no tax on tips thing I've heard about?
Right, that's a big one, getting attention. It's a new temporary deduction above the line, which is good.
Meaning it lowers your income before other deductions.
Correct. For qualified tip income, but it's capped at $25,000 a year. And also for the premium part of overtime pay. It's just for tax years 2025 through 2028, though.
Okay, temporary. But what's the catch? You mentioned risk.
Catch is huge EE. You need meticulous contemporaneous records, like daily tracking.
Wow.
And the IRS is going to be all over this because it's restricted. It only applies if your job is one that traditionally and customarily got tips before 2025.
So not just any tip job started recently.
No, that definition is key. It's a major compliance hurdle and definitely an audit magnet.
Okay. What else impacts individuals? Families?
Well, the child tax credit, the CTC, that's now permanent at $2,000 per child. And there's a temporary boost up to $2,200.
Sounds good.
It is. But here's a fascinating and pretty critical new rule. To be eligible, the filing parent and spouse now need a valid Social Security number, not just the child anymore.
Whoa. So that's different.
Very different. It's a major policy shift. It means many mixed-status families, where maybe the parents have ITNs but the kids have SSNs, they won't qualify anymore.
I see. That's a big impact. Anything for seniors.
Yes, there's a new temporary deduction, kind of a $6,000 bonus for people 65 and older. Same time frame, 2025 through 2028.
A bonus sounds nice. Is there a catch there, too?
Yes. A big one. It's got a very strict income phase-out. Starts at $75,000 for single filers, $150,000 for married couples.
Then what happens if you go over?
You lose the entire $6,000. It's not gradual to cliff. Go $1 over and poof, it's gone.
Ouch. Okay, let's shift to businesses and maybe higher income folks. What's changing there?
Okay, big news on the SALT deductions state and local taxes. The cap is going up from $10,000 to $40,000. That's for 5 years, 2025 to 2029.
That'll help people in high tax states.
It should. But and this is a really big bad, but the act specifically kills the popular workaround, the pass-through entity tax, or PTE, for certain businesses.
Which ones?
Specified service trades or businesses. Your SSTBs. Think health, law, accounting, consulting, fields like that. They cannot use the PTE strategy anymore at the federal level to get around the SALT cap via the business.
So it creates like two different systems.
Exactly. A stark two-tiered system.
Yeah.
And you can bet the IRS is going to be scrutinizing who qualifies as an SSTB very, very closely. Major audit focus area, guaranteed.
Sounds rough for those service businesses. Is there any good news for businesses?
There is. For the non-SSTBs, absolutely. The Qualified Business Income Deduction, QBI, that's now permanent, and it's increased slightly to 23%. And really big for investment. 100% first-year bonus depreciation and the ability to immediately expense R&D costs. Both are permanently restored. That's a powerful stimulus.
But again, mainly benefits the non-SSTB businesses, reinforcing that divide.
Precisely.
So pulling this all together, what should you, our listener, be doing right now?
Okay, actionable steps. First, if you're a W-2 employee getting tips or overtime, start that meticulous daily tracking system, like yesterday. Don't wait.
Okay, business owners.
If you own a pass-through business, you need to talk to your tax advisor, like urgently. Figure out definitively if you're an SSTB or not. Your entire state tax strategy hinges on that now.
And retirees.
Project your 2025 income carefully. You need to know if you're near that $75K or $150 cliff for the senior deduction. Manage your income if you can.
Makes sense. Any final warnings or takeaways?
Yes, a crucial one. Remember the Employee Retention Tax Credit, the ERTC?
Vaguely, yeah. Lots of issues there.
Huge issues, widespread questionable claims. Well, this new BBB Act retroactively extended the IRS audit window for ERTC to 6 years.
6 years. Wow.
Yeah, it signals very aggressive long-term enforcement. And the bigger picture here, the precedent it sets. If these new complex BBB Act benefits are seen as being abused, Congress might not hesitate to give the IRS similar retroactive power.
So the message is,
Document everything. Claim benefits in good faith. Have bulletproof support for your positions. Assume the IRS might look back years later. Don't cut corners.
sound advice.
Okay, let's wrap up. Here's something for you to mull over.
Yeah.
This bill makes the federal estate and gift tax exemption permanent at $15 million per person. That's a really high number.
Huge number.
So it kind of shifts estate planning, right? Maybe less about urgent gifting before rules change and more about long-term wealth preservation, strategic growth. How do you think this redefines how families approach legacy, maybe even philanthropy, over the next few decades? Something to think about.